Welcome back to What Are the Odds? Thought we'd take a little time today to speak about a little bit of a less conventional approach to the market, but I think it's can be sometimes helpful to take a little bit of a new look at the trading activity to get a little bit of a different perspective. So we call this a 30-day score indicator, and essentially what it does is it looks back over the past 30 trading days and assigns each day a positive or negative score, and positive or negative one based on where it closed. Meaning, if the market closed in positive territory, we give it a score of positive one. If it closes in negative territory, we give it a score of negative one. The last 30 trading days are added together, and that gives us our 30-day score indicator. So, for example, if Monday the market closes up 10 points, that gives a score of positive one. Tuesday the market was up, that's another positive one. Wednesday the market was down, that gives us negative one. Thursday and Friday the market closed up. So we add all those positive and negative ones together, and this gives us the final sum of 3, positive 3. Now, taking a look at where we stand right now, today, October 24th, the S&P closed up at a level of 3810 in positive territory, gives us a score of positive 1. Friday, the markets were strong as well. That's another positive 1. Prior Thursday, the markets closed down for the day. That's a negative 1. The rolling 30-day count for today is shown as a level of negative 9, meaning over the past 30 trading days, on average, we have a score of negative 9, and that followed levels of negative 7, then negative 11. It's been in this area for at least the better part of October and the later part of September. Now, what does this mean? Taking a look at the statistics, we can see here the x-axis are the positive and negative score sums, meaning if we have, for example, a positive score of 10, the green dot over here shows us the maximum potential amount of money we could have made moving forward for the next 90 days. The green dot are 90-day maximum averages. Now, we took data going back to January of 1990, so this encompasses a lot of trading data, so it's pretty statistically relevant. So, for example, we can see here with a score of positive 8, the market on average returns a 5% return on investment if you buy the S&P 500 at that time. That's what the data suggests. The blue dot represents a 6-day return on investment. The light blue dot, that's also around a 3% return on investment. Now, on the extreme level, we can see with a positive score of 14, that returns actually a return of investment in the next 90 days around 14%. The individual levels aren't as important as I believe the overall trend of the market and what this tells us. So take a look at some of the worst results in the positive territory is that when you have the market give us a score of positive 1, positive 2, all the way up to, I would say, even positive 6. The superior results really start to emerge when we have scores of positive 7, 8, 9, 10, and above. Conversely, we also tend to see pretty good results when you have negative scores, negative 8, negative 7, negative 6. So point being, if you buy the market as it's experiencing a dip, not a severe recession or not a severe market crash, but very simply when the market dips, we tend to see also pretty good results. When do we see the absolute worst results? When you have scores of negative 9, negative 10, negative 15, and below. That's when the market's in a confirmed trend to the downside. So the point being is that when the market's in a steady trend to the upside and we have a positive score around 8, 9, 10, and above, that looks like a good time, at least statistically speaking, to take a position. And conversely, when the market experiences a moderate dip, negative 5 through, I would say, negative 8, those tend to be good value plays. You buy the market after it's dipped in a long-term uptrend. However, the long-term uptrend then turns sour when we have scores of negative 9, 10, 11, and below that. So it's very good. It's a very easy way, and it's very important for us to confirm the overall market trend. Is it a strong market trend? Is it a strong market trend that's just recently experienced a little bit of a pullback? Or is it in fact a long-term trend to the downside? At the moment, we're seeing scores of -9, -7, -11, -7. If we scroll down, we can see these numbers looked at least a little bit better at the latter part, the third week in September. But from the fourth week of September through present day, it looks like the market's been in a steady trend to the downside. And historically, we can see when the market has readings of -10, we're almost there. We're at a -9 right now. If we start to see more negative days, I think this would really put us in a very confirmed trend to the downside. If the market continues to improve, the past couple of days have been strong. If the market continues to improve, I think that could be a signal that we could see a value play of the market turning back into a positive trend. If you like this approach about looking at statistical data, we have several other videos called What Are the Odds? And we'll place a link here for you as well. We hope this has been helpful. We look forward to seeing you back soon.